day, fellow investors. Theodore asks a great question. One idea to invest in this environment of a clear stock market bubble would be to just leave it to Buffett and buy Berkshire, use his superior 15% tax bracket and reinvesting skill to compound for me and live off capital gains. That's an excellent question, but one thing that in this clear stock market bubble few think about is the price you pay for that service that Buffett is providing for you. That is what I want to discuss in this video, how everything depends on the price you are paying. Because if you look at Berkshire's stock price, yes, it's going up, 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 and up. It has been going just up over the last 40 years, and it more than doubled over the last 4 years. But if we look at Berkshire, there is a target now with the size of reinvesting for an 8 to 10 return on investments, but the market capitalization is $926 billion now. Operating earnings that include taxes when it comes to Warren Buffett are $37 billion. Then we have an additional $8 billion of earnings because when Berkshire owns Apple, they account only for the dividends they receive and not for their share in Apple's earnings. Therefore, I would increase Berkshire's operating earnings to $45 billion. And when you compare that to the market capitalization, you get to a P ratio of 20.57. Divide 100 by 20.57 and you get an earnings yield of 4.86%. Now, if then Buffett keeps on growing the company and they grow at 5% per year, there will be ups and downs, mistakes, then you are already there at a 10% return. That would be the easy calculation, perhaps also Theodore's idea about what's going on, how it's going on. However, first thing we have to understand here, Buffett is reinvesting all the earnings. So if you calculate the earnings plus the growth, you're calculating things twice. Plus, it is a finance and insurance business. Here and there, catastrophes, there are big losses. And then we have recessions, issues, and everything that goes on in normal businesses. So it might not be 8% growth, it might not be 5%, likely above the economy, 3, 4, 5, depends on the next 10, 15 years. Also to show that here we had operating earnings of $27 billion in 2021, $30 billion in 2022, and now $37 billion. The increase in $10 billion is mostly thanks to the huge Treasury position that Warren Buffett has that was yielding 0 in 2021 and now yields 5%. 5% on 200 billion is the 10 billion difference. But Berkshire also as a stock, as I said, and whatever you are buying when it comes to investing, it is all about the price you are paying. Now you can pay $648,000, but just a while ago you could pay just $253,000 per Berkshire share for the same thing. So now you need an amount that just 4 years ago you could had almost bought 3 shares of Berkshire. So if you're looking at, okay, I'm giving all my money, my pension, my retirement money to Warren Buffett, now you're getting just, let's say, a third of the value those buying before you were getting. And therefore, as I said, it is all about the price and what you are getting, because these are all nice calculations, but I can change this and make it a little bit more, let's say, worst case scenario. In case of a recession, let's say that earnings go to 25 billion. From the current 35, he invested in something, it doesn't go well, but it is better than inflation. Treasuries go again to 0, so let's say invested. The P ratio drops from the current 20 to 15, which is also possible. And immediately you don't have a market cap of 900 billion, but you have a market cap of 375 billion. And then you say that's impossible. Well, every 12 years on average, Berkshire stock crashes 50%. That has been the case in history, and I'm sure there will be other 50% crashes. Okay, that is now something that you cannot predict. You never know whether it will happen. But the key question you have to ask yourself is, could I buy more? There is no dividend. Okay, Berkshire would likely do buybacks in that case if the stock price goes lower, but then you cannot count on the capital gains to live off, as Theodore said. So the key question again is, am I okay with that risk? Because we have seen the value was there just 4 years ago, and you think now that is impossible that it happens again. Sven, you're crazy, it's impossible. But I'm not saying it isn't impossible, because we just saw that 4 years. And then also when it comes to investing, the key question is, what is the price you are paying for real investing? Berkshire is definitely real investing, but is that price now worth it? You will get a third of the return that has been given to those buying before. However, thinking of price, that is the key thing here, because very few think about it. The key question you have to ask yourself is, what do I get for what I'm paying? When you understand then you can start investing. I'm not saying that Berkshire will crash. I'm just saying that you have to see how the option that it crashes is compared with the option that it doesn't crash, and the rewards that you are getting from it in case everything is okay. Because if we go back just to the, let's say, negative scenario, 25 billion, that's just a 4% return on the current market cap, plus 2-3% growth over time, that you're double counting because he's reinvesting that for the growth. So let's say on average Berkshire that it grows 5% from that base. Is 5% a good return for you? Keep in mind, Warren Buffett is not doing buybacks now because he considers Berkshire too expensive to do buybacks to give value to his own shareholders. Therefore, just to give you food for thought with this video, and to conclude with Warren Buffett, price is what you pay, value is what you get. And in this environment of crazy financial prices and everything, I would just like to remind you of price, 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 and that you compare it to what you get for that price. Warren Buffett is the happiest now with treasuries, not even doing buybacks, and he's just patiently waiting for getting more value for what he is paying. This is Value Investing. Thanks for watching, and I'll see you in the next video.